Welcome back to Yuri's Box. In this video I'm going to talk about TLT, the week ahead. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So I want to lay the groundwork before I move any further. And I've been saying for the better part of really the last few weeks that it doesn't really pay that much to look at the technical side of charts, because at the end of the day what will really matter is the economic data and economic policy, given all the tariff drama that we saw. Curiously enough, really ironically enough, last week, so the week that just ended, we saw a retest of the trend line we broke out of previously. And funnily enough, it has kind of some confluence here with the lower band of the parallel channel that so far has been the double bottom that TLT has so far put in place. And again, if you haven't watched my previous videos where I talk about TLT, the idea basically is that TLT, basically the 20 and 30 year bond ETF, has a history of putting in double bottoms. And the two examples I pointed out were 06 and 08, and 07, really, the 06-08 cycle, where you had a first low followed by a sweep of the previous low, so a second lower low. The second option is something like what happened in 2010 and 2011, where you had the first low followed by a higher low. So far, if this parallel channel is to believe, and again, I've been, just being, discounting, the technicals of the chart. But, the irony of it all is that, price action has a way of, shoving it in your face. And, again, we can all come back here and point and laugh. And again, it's incredible. I mean, what I'm talking about is what we saw right here, the confluence of everything. But in any case, for the time being, TLT seems to have put in a low followed by a slightly higher low. Now, a lot of this banks on whether what we saw last week in terms of selling is something structural, or it's something that, as I believe, was led mostly by forced liquidation and forced deleveraging. Who, I have absolutely no idea. Will it continue? Possibly. Although I think that today was really a big clue, in my opinion, to what could happen next week. And what I'm talking about is this right here. What basically happened today is that Trump basically walked back the tariffs. Because, when you exclude phones, computers, and chips, what's left? Soybeans? Yeah, okay. But, the pain that was being caused by these tariffs was, of course, if you look at the queues, all right? What's in the queues? Nvidia, Apple, Tesla, they're all based in China, de facto, all right? So if you're putting 145% tariff on, chips and technology, basically, well, what are you going to expect, technology stocks are going to do? They're going to tank. So just to go over briefly on the stock side of things, I would not be surprised if we see actually some continuation of, this huge green candle that we've seen right here, simply because, I've been the first one to really raise the cautious alarm, all right, a beige alarm, all right, because what we were seeing was the market continued to not really believe Trump and not take him at his word. And granted, that is where we got, because all right, this is what we're talking about. We're talking about Trump actually walking back everything. But it was a pretty wild week, all right? And Trump said something crazy, right? Like 50% tariffs on China. The market said, you're not going to do it. And then he said 100% tariffs on China. And then he said, you're not going to do it. And so on and so forth until we got to 145%. Now, granted, this whole shenanigan with this trade, deficits and tariffs have really been, well, they haven't led to anything. I mean, what has Trump achieved? I mean, going into this, I was the first to outline, just being completely honest, I was the first to say that anything that was more on the harsher side of the equation was probably an indication that tariffs were never going to be structural. They were just going to be a bargaining chip. But I mean, you're basically caving in at this point. So I would just take more of I would fade any tariff, fear at this point. And, you might say it's late now because I didn't buy the bottom. But what I will say what I'll say to that is that you don't want to be a hero, all right? You don't have to buy the bottom. And the market will be here in a month's time. You don't have to buy the absolute bottom. Nobody buys the absolute bottom. It's perfectly fine to wait and see if insanity is followed by more insanity or if it's followed by people actually, being level-headed. Thankfully, I mean, this is welcome news. I mean, this was kind of leading nowhere, I think. I think that is what really became apparent. It wasn't, nothing really got achieved. There was a lot of noise. And for what? Okay. So what does this mean for stocks? But again, things can change. Again, it's been a wild week. It's only been 10 days and it feels like a month. So again, I wouldn't be surprised by anything. But at the same time, given it's basically game over at this point, I mean, I go into this week expecting stocks to follow through. Again, unless we get some weird tweet, now that I go to sleep. But my expectation is that for now, stocks just continue to go up. And on the S&P, I actually would not be surprised if we go back to, eventually, the 5,900 area, which is an area that I highlighted while we were right here in the beginning of March. I was pointing to the fact that we might get up to 5,900. We actually got up to 5,700, nearly 5,800. I would not be surprised if this actually plays out slowly. It slowly starts to grind higher until we get to the summer. All right. And I think that this is a good place to switch to bonds. Because what does all of this tariff drama mean for bonds? I think that as time goes on, and again, it'll be noisy. I'm expecting a lot of noise from here till the summer. Because let's face it, I mean, Trump did basically walk back everything. But he still has to pull something out of it, all right? Just to save face. Meaning some kind of an agreement with Europe. I think that on the European side, most likely outcome is some kind of a deal with energy. Basically because Europe is still buying energy from Russia. So it is asking the US to protect itself from Russia while it buys energy from Russia. Make that make sense. And on the China side, I don't know. They'll figure something out. All right, so I'm expecting noise on the tariff side of the equation, but I expect it to be noise from this point on. Now, I can't say anything else after reading something like this. Okay, while I still maintain some kind of a cautious outlook, I think for risk assets, it's kind of the green light in my opinion. Now, on the bond side of things, as we move towards the summer, I expect there to be a shift back to what is the data. I think that as time goes on, we will slowly shift our eyes back to the data. Meaning, what we saw at the beginning of the month with non-farm payrolls actually being, a non-event, I'm expecting that to reverse next month. I'm expecting the data to actually have an impact, given also the fact that, going into this, we had, and I spoke about this many, many times, and in case you haven't watched my previous videos, I've been pointing towards the fact that going into the year, many people, consensus was that growth is okay, the problem is inflation. And, ever since I started making my videos, I pointed out the fact that I was taking the under, meaning growth is probably less okay than people think, and inflation is probably a little bit better than people expect. So more optimism on inflation, more pessimism on growth. Right, that is my base case going into 2025. And why was that my opinion? And still is my opinion. I looked at the quits rate. All right, what is the quits rate? It is a measurement of how many Americans are leaving the job on a voluntary basis. And what does that entail? That entails that basically, if the quits rate is at cycle highs, it is a survey. All right. The quits rate as a whole is a survey. That is the way you should treat it. And if the number that the print and the quits rate is at cycle highs, you can take that as an indication that labor market participants see abundance in the economy. They see the fact that they can switch jobs easily. That drives wages higher because, again, they can switch jobs and get a higher wage. And the fact they can switch jobs and get a higher wage is a good enough reason to go to the current boss and say, "Mr. Boss Man, fork up 6-7%, because otherwise I'm going to switch jobs." And when you're at cycle highs, that usually is called an employee's labor market. When you're at cycle lows, the opposite is true. It's an employer's labor market, meaning that employees no longer have the leverage because they don't see the abundance that they saw back here, which means that wages are going to likely stay flat, which will feed into consumption. And therefore be actually good for inflation, because people no longer have the tool that they had right here to bid up inflation, and bid up goods. Because the only way you're going to keep up with inflation like we saw in 2022 is if you have a way of driving up your wages. And this is not what we've been seeing so far. And actually my expectations for the year when looking at inflation, I don't know, this still hasn't updated anyway, but in any case, going into 2025, I highlighted the fact that from the fall to around January and March, we do tend to see inflation be a bit sticky. And this is what we've seen, so far in 2023. We've seen the same thing happen. Inflation bottoms, it stays sticky around the 3 and 3.5. Why? Well, think about it. You have the holiday season in between. People get their end of year bonuses. People travel more. People spend more. They go out more. they buy gifts, people spend more. So it tends to push or make inflation a bit more sticky. But eventually, we get through it and we continue on the previous trend. Now, I made the case that in September 24, from September 24 to recent months, we've had, again, holiday season. But on top of that, we had port strike fears in September. So front running of orders, in order to avoid potential port strikes. Then you had natural disasters in October and in January. Then you had tariff front running. All right. So what occurred here is potentially a series of transitory events. I'm using the T word knowingly, that potentially made inflation look worse than it actually was, and actually made growth look better than it was than it actually was. And going into 2025, I was expecting inflation to peak and roll over. All right, and here we go. That was just the interval, and that is basically what we've seen here. We've seen inflation peak at 3%, and we've really gone for a nosedive. Okay, we are at 2.4%. Now, I've spoken about the potential for, downside surprises on inflation, and I've made the parallel to something like we saw in June's inflation report. Because what we saw in June was, yes, good news on inflation, but perhaps too much disinflation, all right? The possibility of undershooting the 2% target. And again, this is something that I think that slowly, as we move out of this kerfuffle, as Jamie Dimon has hinted at potentially, as we get out of it, we get back to focusing on the economy, we get back to focusing on the meat of the data. And what is the economy telling us? The economy is telling us that inflation is no longer a problem. It is telling us that potentially, just by looking at something as simple as the quits rate, it is telling us that people no longer see the abundance in the economy. And that means to me, that tells me pessimism on growth, right? And I'll go on a tangent for a moment, and I'll actually point to where is it? Right here, the survey, the consumer survey made by the University of Michigan actually got released on Friday. Now, we saw downward surprise on everything except inflation. And I've made my thoughts quite clear about why I tend to discount the University of Michigan surveys and surveys in general. And the explanation is right here. What you see right here. Inflation expectations based on, political leaning tell you everything you need to know about this sort of survey. Democrats, ever since Trump got elected, are expecting Weimar Germany. Republicans, ever since Trump got elected, are expecting, the land of Oz. No, definitely things have ticked up a bit. But, it's hard to look through. It's hard to discern signal from noise when it comes to, especially the inflation side of things, or even in general expectations about the economy, because whenever you ask for someone's opinion, they'll give you their opinion, as I say many, many times. The problem with that is that it can easily be skewed by political leanings. So, again, it is very difficult to find signal, in my opinion. Again, I'm not totally discounting them, but if I had to choose, as I say many, many times in my videos, between something like the University of Michigan Consumer Survey or the quits rate, I'll always choose the quits rate, because the quits rate is a survey of people's actions. It is telling you what people are doing, not what people are thinking. And regardless of, whether you're Republican or Democrat, if you're quitting your job, you're optimistic about the economy. You can be, you could have been the most ardent Trump fan, red hat, make America great again. You're quitting your job. You're telling me that the economy's great. All right. Same thing down here. All right. Now that Trump is in office, you can be Trump fan number one, but if you're not quitting your job, that tells me that, you're potentially not feeling too good or too great about the economy. And this leads us to really having to deal with potentially who is to blame, right? Because I think that is eventually where we're leading, where we're going to get. And this is what I will say. There are things that were clear already from last summer. And I continue to point to the fact that what we saw from September till January, in my opinion, was not a result of rate cuts. Right? I've made my thoughts clear on that. Meaning that, really, in my opinion, rate cuts and rate hikes work with lags. It takes a lot more time than 3 weeks to feel the effect of any kind of cuts. All right. What happened here from September to January were transitory events that made the economy potentially, it kind of gave it a shot of adrenaline, all right, between everything that occurred during this time frame here. Okay. And and before this, actually, before this bottom in inflation, we actually had a growth scare in August. We had a bad report for the month of July and a bad report for the month of August, with revisions pushing those numbers down by a lot. And the actual final revisions for the whole year point towards an even worse picture. All right. And the only reason why 2024 looks kind of okay is because of the huge gains in payrolls that we saw in December. That's it. 2024 was not a good year for the economy, in my opinion. And I think, as I've been pointing towards, that really what we're starting to see now is a return to the conditions that were highlighted during the summer months that we saw last year. And that this right here was, let's call it a head fake, right? So where does that leave bonds? The key question, in my opinion, for really the week ahead and what to expect, because we really don't have that much happening next week, in my opinion. Yeah, we do have retail sales on Wednesday. Keep an eye on that for any further front running, especially on cars, on autos. But again, we really don't get anything significant. Maybe perhaps a read on the manufacturing indexes, but nothing too extravagant. I think that the biggest thing to look for next week is whether in fact the squigglies on the chart will have their revenge, meaning that we've tagged this lower trend line, and this is actually the monthly. We tagged this trend line and potentially rip the faces off of everyone that has been hanging their hat on the theory that nobody wants to buy American bonds and the dollar is going to zero, and buy the euro, buy yen and whatever. And that hinges on the fact of whether what we saw this week was, again, something structural. And so is it in fact that everybody's giving up on America? Or was it some simply liquidation? I still tend to think that it has to do with forced liquidation and forced deleveraging. We'll see. I think that is the first question that needs to be answered next week. I would not be surprised if we open the week somewhere around the $86 mark, and we just slowly grind higher, right? If again we get policy cooperating, meaning that potentially start seeing some trade deals or some further talk about trade deals, and again if this forced deleveraging actually stops, and again it'll be a question of trying to see if it is indeed forced deleveraging or it is something worse. I tend to discount all of the doom posting, but again, time will tell. So really, for the week ahead, there's nothing really happening next week, in my opinion. What you'll have to pay attention for is any potential reversal of this candle here, in my opinion. And if we do see a reversal, so some kind of engulfing candle, that would be an indication that what we saw last week was liquidation, deleveraging. If you actually see this just continue, which is a possibility, meaning that all of the everybody's leaving the US and doom posting has some ground, you could actually see, in my opinion, a sweep of the prior low, which is definitely a possibility. If I had to give my 2 cents, honestly, I've been fading the technicals, or really the squigglies on the chart, as I call them, for again most of my videos. I have to give credit where credit is due, and I wouldn't be surprised if actually this ends up being correct. And again, we see some kind of open lower around the $86 mark, and we just grind higher in an engulfing candle, potentially, if again I'm correct in interpreting this selling pressure right here as forced liquidation. So I guess I'll leave it at that. There's nothing really more that needs to be said, in my opinion. If we do get a reversal and actually get back under the bull market support band, this is the 30-year bond. If we do get under the bull market support band, in my opinion, that would still make the 2006 and 2008 cycle potentially viable. Although this candle right here is kind of a game changer that is hard to ignore. But again, we'll follow things and see how things evolve. I'll leave it at that. This video has been hard to make because I have a very bad throat. My throat hurts a lot. That's what I'm trying to say. So I hope you enjoyed the video anyway. If you like this kind of content, consider leaving a like and subscribing, and I'll see you next time. Bye.